Hi there, Shingrai here again with an update on some of the key themes, ideas, and events that have been shaping portfolio performance over the past week. All the CBAM portfolios have underperformed their respective benchmarks over the past week, and I think that's largely attributable to our 3% underweight in US equities and European equities, and of course the runway performance that we've seen in US tech stocks, driving the broader US indices further into the green. That would mean that the benchmark portfolios have clawed back some of the gains that we had made above the portfolios in Q2. But however, on a year-to-date basis, portfolios 1, 4, and 5 continue to outperform benchmark, whereas portfolios 2 and 3 underperformed the benchmark by about 40 basis points each. In terms of portfolio performance down to the fund level, I think another narrative here that's really paying out over the past week has been the runaway performance we've been seeing based on optimism in broader Asian stocks, stemming largely from regulatory support that has been committed to Chinese equity markets by the regulators in China, and that would see over the past week the emerging markets indices, Indian subcontinent indices, as well as iShares S&P 500 being the top performing funds over the past week, whilst conversely over the past week the worst performing funds would be our emerging market bond index in an environment where US dollar has been somewhat strengthening given some concerns globally around how quickly economic recovery could come to reboost consumer consumption. On a year-to-date basis, the star performer in terms of our CBAM portfolios has easily been our iShares Physical Gold, in which we hold overweight positions across all 5 of the portfolios, and that has returned 23.66% on a year-to-date basis, whilst our pound index-linked gilts position has returned 12.87%, and of course our USD corporate bond position has been also top 3 performers, returning 11.51%, and we have been overweight in North American fixed interest across all 5 of the portfolios. In terms of worst performing funds, the FTSE 250 mid-cap tracker, the FTSE UK smaller companies, and the LNG UK 100 index trackers have been the worst performers, returning less than 15% or less than minus 15% rather on a year-to-date basis. And I think that's just been largely based on some of the pressures that the UK economy would be facing in terms of fiscal stimulus in response to the COVID outbreak, as well as uncertainty that has been lingering with regards to the Brexit situation.